I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Let's get straight to the burning issues, the great privatization of public markets, with KKR formalizing its plan for what may become the world's biggest leveraged buyout. Plus, Wall Street dealmakers create their own unicorn as they embrace the booming field of direct lending. And a discussion with the head of private markets for one of Canada's biggest pension funds. Let's get started. With me, I'm so glad to say, is Bloomberg's Sonali Basak, Kelsey Butler, and Davide Shiliuzzo. We begin with Sonali and KKR's possible bid for Walgreens Boots Alliance. The private equity firm has formally approached the drugstore chain about taking it private. This leverage buyout could be how big?
No small deal. It could be the largest in history. It could edge up to $80 billion. When you think about the premium that the sponsors would need to pay, remember it's $56 billion in market value, another almost $17 billion in debt value. That means when you break it down, it would maybe be about $20 billion in equity at the very minimum and another 50-some billion in debt.
What's the logic behind taking it private?
So you have Walgreens here. If you look at the stock price alone, that'll give you the answer. It's been falling quite a bit while the public equities markets have been rallying really for the most part. And they've been really competing with the technology industry that's been taking over this retail play. And it's hard for them to grow and invest in what they need to compete with the Amazons of the world.
How feasible is it for them to get this deal done?
Well, look, it depends on who you ask. If you ask Steve Schwartzman, the head of the largest ever private equity firm, Blackstone, he says this is not possible. But KKR's obviously made the approach here. You have Goldman Sachs, John Waldron, the president, told me just last week that he believes that there's enough capital in public markets to really make this happen. And so it's a debate for
sure. There certainly is a lot of capital, which brings me to Kelsey. This flood of money raising questions about leveraged debt of all sorts. One player recently said it had gotten grossly out of control. He was speaking about the leverage lending market. Kelsey, please explain.
Yeah, so Dan Zwirn from Arena Investors said that the leverage lending market is, as you said, grossly out of control. In particular, the middle market private debt space. And that's mainly because of private equity, he says. As purchase price multiples have just risen, so has leverage, and credit quality in turn has deteriorated.
What's the consequence of this? Does he expect a rash of defaults, or is he recommending some prescription for investors to be more prudent?
Well, in his space, he has a pretty broad mandate. So he's looking into more nichier parts of credit. We're thinking special situations, real estate. He also likes oil and gas lending where there isn't as much competition for deals. But he says recoveries may not be as bad as people fear, but it's still going to be a rough ride along the way.
All right, so grossly out of control, but not about to collapse, akin to 2008.
Exactly.
All right, which brings us to Davide, because we can see this flood of cash continuing to go into private markets. Davide, you reported that Apollo Global in particular is planning to capitalize on this. How so?
That's right. They're planning to double essentially their assets under management. That will bring them to around $600 billion over the next 5 years. That's significant because a lot of that actually comes from credit and from a privatization of credit markets that they expect will play out even more so over the coming years. One thing to remember about Apollo is that already 2/3 of their assets, so around $200 billion, is in credit. So they think they're very well positioned to take advantage of that.
And they expect their assets to double in the next 5 years to $600 billion. How has their credit arm done so far with this great privatization that we've seen?
It's done very well. Of course, they have the advantage of controlling Athene, an insurance company that provides a lot of the money to invest in credit. But they've also made sizable commitments themselves. Earlier this year, they agreed to finance a $1.8 billion loan for New Media's acquisition of Gannett. This is a deal that even a few years ago, it would have been unthinkable to be put together outside of the banking world. And now they're coming up with the check themselves.
It's just amazing that they have doubled their assets in the past 5 years to about $300 billion of assets, and now expect to double it yet again in the upcoming 5. Thank you so much, Davide, and all of our reporters. There is so much money and interest in private markets that many are starting to wonder whether the market is getting perhaps a little frothy, which brings us to our first guest. That's Susan Kassar, co-head of private credit at Neuberger Berman. I recently spoke to her about the potential froth in direct lending.
I think the amount having gone in doesn't necessarily indicate froth. I think people are maybe conflating two things that are happening at the same time, and I wouldn't say they're not at all related. So I think for all asset classes, we're late into an economic cycle. People feel like risk is on, valuations are high, it's hard to find yield. And so in private credit, like any other asset class, public credit, public equities, private equity, real assets, yes, I would say valuations are stretched, and it's worth asking, is risk-adjusted return the best it's ever been? In private credit, probably not. But not bad, actually. Not
Really?
bad. Yeah, not bad.
Okay. What about second lien?
Good question. So in our investment portfolio, we've tilted very strongly away from second lien and towards first lien. So have many other people, and so it is worth asking the question, is maybe now there's slightly better risk-adjusted return in second lien, but people aren't necessarily doing that just to optimize risk-adjusted return. They're doing it to position themselves for an eventual recession, whenever it might be.
Going forward, a lot of people are saying they expect many more public to private deals, sort of what we've seen proposed out of the Walgreens Boots Alliance, which may or may not become the world's biggest LBO ever. A lot of people sort of casting some doubt on the potential. As a debt investor, how amenable are you to financing some of these transactions?
Public to private?
Yes.
I think that would be wonderful. I think one of the criticisms people have made, I think fairly, about the credit markets broadly syndicated loan markets in particular, have been the amount of add backs to EBITDA. I think one of the easiest add backs to EBITDA to get around is public company costs. Now it's a private company. And I think that the more opportunity set we have to look at as a lender, as a private lender, the better. So this trend that people have been talking about, fewer companies want to go public, fewer companies want to stay public, that's fabulous if you're a private investor.
So what industries are you seeing as potentially fruitful when you're sourcing deals?
So I love it when people ask me this question, because they forget that I'm a creditor, which means that even though I smile a lot, I actually hate everything. So for example, I love healthcare, right? Personally, actually. Healthcare is a big part of GDP. It grows at a rate much faster than GDP. It's recession resilient or recession resistant. But I also hate healthcare because you can have payer concentration, you can have regulatory risk, you can have reimbursement risk, you can have issues with data compliance. And so overall, we tend to look for companies that have high growth characteristics, some amount of barriers to entry, good free cash flow prospects. And then here's the hard part. Once you found these like beautiful little treasures, they're not levered to the moon. The documents are intact, mostly, and the coupon is compensating you for the risk. So really, we're looking for a needle in a haystack.
How big is the pool of private capital right now for debt markets, and how much do you expect it to expand over the next few years?
Well, it's interesting. I think people sometimes fail to appreciate that private credit also competes with the broadly syndicated loan market. So they think that private credit exists in a vacuum, and for companies with less than 40 million of EBITDA, it mostly does. But private debt, private credit is routinely extended to companies with 100 million, 250 million, 400 million of EBITDA. And so once you get anywhere near those sizes, you're competing with the broadly syndicated loan market. So I think as more capital flows in to the loan markets, to the private equity markets, to the private credit markets, the ability for private investors to access bigger companies, more companies, just expands, and that's good.
That was my interview with Susan Kassar, Neuberger co-head of private credit. Coming up, this week's power player, Mark Redman, global head of private equity for OMERS, which is the nearly $100 billion Canadian of pension fund. He also noticed the KKR Walgreens headline, and he says it is a symbol of the times.
The propensity to do public to privates is not surprising in itself. There is also a lot of capital, a lot of money around, a wall of money, if you like, within private equity, looking for a home, looking for a place to invest.
I'm I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. As pensions are plowing more and more of their money into private markets, some are starting to compete directly with private equity funds by investing in companies directly. The Ontario Municipal Employees Retirement System was one of the pioneers in this space. I recently spoke with Mark Redman, head of their private markets unit, about their experience.
It's fared very well. First of all, if you look at our returns certainly from a private equity perspective have been top quartile. We're very proud of them. And it's very interesting if you look at the history of why that happened. That is a peculiarly Canadian phenomenon. Ourselves, along with outfits like Teachers, CPP, we're in the vanguard really of making direct investment. And that has proven very successful not only for ourselves, but the Canadian pension industry more generally.
I was speaking with Kassar's chief investment officer, and I asked him about going direct, and he said there are a lot of barriers to entry in terms of getting the skill and getting the research. How have you surpassed those hurdles?
I think he's absolutely right. And there's a matter of you don't want to be too big and you don't want to be too small. If you're too small, you won't have sufficient assets under management. You probably won't be able to attract the sort of people that you want. If you're too large, it's going to be hard to deploy the amount of capital you need to purely direct, so you're going to rely on funds. As OMERS, the sort of size that we are, $100 billion fund, as you said, just north of 10 billion assets under management in private equity, we're neither too big nor too small. So it works for us very well in terms of having a direct program. I'd
love to get your sense of where you see the opportunities right now. A lot of people think we're in late stage all around, particularly in private markets, where people say that they could see potentially bubblicious behavior.
Yes.
What's your view on that?
So there's no doubt, first of all, we're 10 years into an upcycle. So I think we all know that's the case. I mean, as OMERS, we see opportunities across all private markets, continue to see those opportunities, real estate, private equity and infrastructure. But you're right, if you look at pricing, if you look at debt availability, it is close to or at all-time highs. However, we are a pension plan. We think long-term. So in the end, if we can acquire top quartile assets, top decile assets even, over the long term, we believe those assets will make returns for us. So we try to not just play the market, we try to think long term. And if you think that, then it makes a real difference. And you can still deliver the returns over time.
Do you think we're at the top of the market?
I think we are.
How long do you think it has?
That is a very good question. And of course, if I knew the answer. But I think the way that we look at that question at the moment is to say to ourselves, do we sort of withdraw from the market altogether? We have been active sellers into this market over recent years. So we have taken advantage of what we see as buoyant market conditions. But are we still investing? Yes, we are. We tend to look at this from a vintage basis. In other words, let's invest on a year-by-year basis. Let's not overinvest, but let's not underinvest. We're not smart enough to call the market. But if we invest in top decile assets, we will be fine.
If you're net sellers, does that mean that you have a lot of dry powder at this point?
Yes, we do, but we're not alone in that.
Can you give us a number or anything?
Oh, I mean, dry powder would be 5-10 billion comfortably.
What regions are you seeing that still hold opportunity, given the fact that you are net sellers and do think that we're at the top of the market?
I think all regions present opportunity. If you look at, I think we're particularly focused on North America, and if you look at the economic dynamics within the US, for example, they are still, relatively positive, certainly relative to other geographies as well. There are pockets of opportunity in Europe as well, and we've just started in Asia Pacific as well. We have an office in Singapore. We're looking at the Australian market as well. So we're global investors. We look for opportunities on a global basis.
When we talk about private equity and the dry powder that's been accumulated, what do you have to see to say now's the time to deploy it?
I think it is a set of criteria, old-fashioned private equity, as I would call it. Growing businesses, cash generative, market leaders, demonstrably diversified by geography and product, and demonstrably resilient to recession. And if we see those criteria, that encourages us to invest, even at what is probably the top of the cycle. I'd
love to get your sense on the bubble that we hear about in private equity.
Yes.
Do you think that there is a bubble?
I think that there is bubble. You can argue there's a bubble across all markets. I see very few markets, whether it's infra, real estate, capital markets, or private markets, private equity, that are undervalued. So do I think there's a bubble? I think there is a bubble overall, and certainly pricing seems to suggest that's the case. It doesn't mean you can't make returns. It just means it's much harder.
That was my conversation with Mark Redman of the Ontario Municipal Employees Retirement System. Time now for our real estate roundup. Blackstone's real estate group is one of the biggest and best performing franchises at the nearly $600 billion alternative asset manager. The division is run by Ken Kaplan and Kathleen McCarthy. Bloomberg's Eric Schatzker sat down with Kathleen to discuss where private equity, where the giant is finding opportunity within real estate.
Logistics continues to be our highest conviction investment theme all around the world. And that's just because we see technology totally transforming the way goods move from businesses to people. And so our business has followed that too. Over the last decade, we've bought 1 billion square feet of warehouses, but increasingly we're focused on those last mile locations and where we can be in the most infill spots in the densest population centers.
And sticking with real estate, Barry Sternlicht's Starwood Capital is returning to the single-family rental market. Bloomberg has learned that the firm has bought hundreds of homes through third-party platforms Roofstock and Tiber Capital Group. The firm is testing the viability of a larger investment. Coming up, the White Claw craze, how the creator behind the hit hard seltzer is now a multi-billionaire. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Well, it's Wall Street's very own unicorn, Owl Rock Capital. Bloomberg is reporting that the firm, founded by a trio of veteran Wall Street dealmakers, is selling a 20% minority stake that values the firm at about $2.5 billion. Here with more is Bloomberg's Sri Natarajan. First, what do we know about this firm, Sri?
Look, this is a firm that has been started by 3 very successful Wall Street dealmakers who've gone out and started in a space that just seems to be right place at the right time. Just when private credit has become this investment buzzword like crypto or cannabis, and you really have to see the macro backdrop for that, right? You have people wondering whether we're in this lower for longer forever environment, and traditional fixed income vehicles are just not going to cut it. So you have these 3 people with very high pedigree from Goldman Sachs, from KKR, from Blackstone, setting up their own platform, but really going from zero to a fairly large platform where they've scooped up $15 billion in assets in under 4 years. And that's why you see the valuation that they have got on their company right now, which is about $2.5 billion, which, if you ask their peers, is really remarkable in such a short period of time.
All right, so Sri, they're good at raising money. How do they make money?
The model is simple: scoop up assets, and they've done well on that front. They have about $15 billion in assets. Find mid-sized companies, find companies that used to get their loans from banks, but banks have deserted that space. But there are still many companies that need to thrive and grow. So that's where these direct lenders like Owl Rock come in and offer their loans. They then get a steady stream of interest from that. Most of that goes to investors, but they get to pocket the management fee and the performance fee, and it's a fairly steady cash gusher, and that's why you have someone like Dial willing to buy a 20% stake by pumping in $500 million into this company.
So it's mostly a fee-driven model, correct?
By and large, I mean, that's the part that's predictable. Then there's the management fee. It's sort of 2 and 20. They have done the good, smart thing of going with the idea of hook 'em for free, offer a lot of concessions to begin with, and after a while, the management fee and the performance fee start kicking in.
Sri Natarajan, thank you so much. A really excellent story. I recommend you read it. Now to this week's Billionaire Beat, and we are looking at the man behind White Claw, the hard seltzer that took advantage of more health-conscious drinkers. Bloomberg's Tom Maloney is with me now. So tell us about the person who made more than $3 billion selling hard seltzer.
So this is Anthony Von Mandel. He's based in Vancouver, actually, and he owns a company called Mark Anthony Brands, which he founded. They came up with White Claw a few years ago, but it's really exploded in popularity this year. People were saying it's kind of the summer of hard seltzer. It's had triple-digit volume growth over the last year, and White Claw itself has sold more than $600 million worth over the last summer.
I love calling it genre-defying alcoholic beverages. What does that mean?
Well, I think it's kind of like a near beer type of thing, right? And it's not the first beverage in this category that he's come up with. He actually made a lot of money with Mike's Hard Lemonade, which is also a company that he invented back in 1996. So he's been doing this for a long time. But actually what we found during the course of this reporting was that his true passion seems to be wine and not hard seltzer or Mike's Hard Lemonade.
I love one magazine called him British Columbia's God of the Grape. So is that what he's doing with his money as he's pumping it back into his vineyard?
Yeah, absolutely. Multiple vineyards, actually. He has 5 now. He's about to close on his 6th. He has all of these vineyards in a region called the Okanagan, which is about 4 hours east of Vancouver. Looks stunning, and he's just had so much money to play with there that he's really been able to put the whole region on the map.
I was impressed that over the past 12 months, sales of hard seltzers almost tripled, and that White Claw solidified their market share. Who are their competitors at this point?
So their biggest competitor is Truly, which comes from Boston Beer Company. They make Sam Adams. So that's only got about 15% of the market share, though. White Claw has closer to 60%. A lot more competitors are going to be in the market next year. You know, the big brewing companies are taking notice and pushing back. So it'll be interesting to see whether White Claw can hold on to its lead.
What's the health story here? Is it just fewer calories?
Yeah, fewer calories, fewer sugars. I mean, really, you could look at this product as an evolution of Mike's Hard Lemonade, except that they've dropped a lot of the sweetness. They're trying to appeal to a more health-conscious consumer. You know, people, Nielsen talks about mindful drinking a lot as a kind of a 2019 story. And
that's a 2019 phrase for sure.
Yeah,
go on.
Absolutely. So this is kind of appealing to a younger consumer that wants to be able to drink socially without worrying about the calories.
Mindful drinking, genre-defying alcoholic beverages, community-adjusted alcohol. Can we go there? Tom Maloney, thank you so much. Are you going to be drinking hard seltzer this summer?
No, I'm more of an IPA guy.
Yeah, an IPA guy. And it's brewed, right? It's not...
That's right. That's part of its appeal as well. It's brewed, which is mostly for tax purposes.
Tom Maloney, thank you so much for bringing us that. Speaking of big money, it is time for this week's big number. We turn to art auction markets to find the figure of $1.2 billion. That is the semi-annual sales of high-end impressionist, modern, post-war, and contemporary art at Sotheby's, Christie's, and Phillips. They are targeting sales at that number, which is at the low end of the estimate range, down 24% from a year earlier. We do have investors willing to buy, but people do not see this as a particularly hot market to sell into. So that is the challenge, to get those sales numbers up for the art market. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, and 2 a.m. in Hong Kong. From New York, this is Bloomberg.